All right. Well, we will maybe dive more into goth rap in today's proceedings, or maybe we'll just stick to the numbers. But welcome everybody to our second of three Forecastr Fridays. Last week's was a powerhouse session with Logan and Calvin from Forecastr on how to build a financial model. It's Financial Modeling 101. Today, we are going to build on top of that. And if you missed last week's, go back and watch the recording for that. And if you are watching this on recording right now, well, hello from the past, and I hope the future is a little bit better than the present. So today, Forecastr Friday number 2 is we're going to take the concepts we learned from financial modeling last week, and now we're going to see how do we apply these concepts? How do you apply your financial model to actually go out and raise capital? Not just any capital, but the right capital, and faster than you otherwise would. So with that, I'll turn it over here to Logan at Forecastr to do his magic, and I'm ready to be wowed. I've got my notebook out.
Oh my gosh. Well, I'm ready to wow you guys. All right. Well, thank you so much, Raj, for the wonderful introduction. And thank all of you all for joining for this next iteration of Forecastr Fridays, which we're really excited about being able to present on this type of stuff. So on the front end, first of all, obviously, thanks everybody for joining. There may be a little bit of overlap on some of the material from last week, but that's good because it's going to be a refresher. So we'll see kind of like who was paying attention and who wasn't. But for those of you who are new, you're going to get the full experience, which is great. But I'm super excited to be chatting with this about financial modeling specifically for fundraising, right? So whenever we think about the use cases of a financial model, we went through this last week. We broke it down into two main themes, which is a financial model is going to help you raise capital, and a financial model is going to help you be more efficient and run your business better. Today, we're specifically going to be focusing on the front half of that, right? Like how a financial model is actually going to help you raise capital easier, right? So there's no silver bullets whenever it comes to raising funds. I think we all know that fundraising is hard work, but I'll share kind of the story of the real tangible value proposition that a financial model can have, specifically when it comes to raising money. So whenever Forecastr was coming out of the gate, right? We were brand new. We were in Louisville, Kentucky, and we needed to raise money for our own company, right? We were trying to raise $600,000. We had no revenue. We had no product. We really had absolutely nothing, no traction to speak of whatsoever. And so whenever it came to de-risking an investment for the investors, the only thing that we could lean on was essentially the theory of how things were going to come to be using really, really sound logic. And so we leaned heavily into our financial model, which showed the future of Forecastr as we saw it in our mind's eye. And then we used that as a communication tool to help convince investors that we knew what we were talking about. So even though we didn't have a product or revenue, that was a way to de-risk the investment for the investors, was to show them that we had a plan, right? We were going to be a good fiduciary of their investment because we knew how we were going to deploy their funds and turn those dollars into more dollars. And then, after doing that, we were actually able to oversubscribe that round to 750,000. And ended up, getting into Techstars and all of that. Now, since then, we've raised even more money. We've raised over 5 million in total, and we keep following this process and just leaning on that model really, really hard. So again, not a silver bullet, but a great financial model is one of those arrows in your quiver, a really, really powerful one, and probably your most underutilized one. We found that most people don't lean on that. And today we're going to be teaching you how to lean on it and how to use it as really one of your secret weapons when it comes to fundraising. So for those of you that were here last week, you already know me. But for those of you that weren't, I'll do a really quick intro on myself. I'm Logan Burchett, co-founder, COO over here at Forecastr. And I've been in finance my entire career. I'm a finance nerd through and through. I've done anything from managing the Kentucky Pension Fund stock portfolio for a number of years, to working in investment banking for a brief period of time, to becoming a fractional CFO for dozens of venture-backed companies. And that last piece is where I learned the ins and outs, everything there is to know about financial modeling, specifically for venture-backed startups. And that's ultimately what led me to starting Forecastr, what led me to meeting Steven, who's on the slide here next to me. And between the two of us, we built hundreds of financial models. and I'm a finance mentor at Gus, Techstars, New Chip, GSV as well. I'm a founder myself. Forecastr's got over 550 clients now, about 1.4 million in revenue. And I'm personally, me and my co-founder, Steven, are in the throes of fundraising at this very moment, where we've got an active Series A that we just kicked off a few days ago. So we're going to be, you betcha, applying all of the stuff that we're going to be talking about today. So we're living, breathing proof that this stuff actually does work. And again, if you were here last week, you'll kind of know who Forecastr is. But Forecastr is an online software that helps founders build great financial models so that they can understand their numbers, make better decisions, and get funded. Again, today we're going to be focusing on that last piece, that get funded piece. But in general, what we're trying to do is we're just trying to surface all of the value that financial modeling has. Now, financial models have been a large part of businesses for really since the dawn of time. Like, businesses have always been building projections and been forecasting revenue, expenses, planning cash, all of that. But it's all been done in Excel to date, which is shrouds it in mystery, right? Because Excel's hard to learn. It's clunky. It breaks a lot. It's a specialized role, being kind of a financial analyst or a finance expert. So what Forecastr is doing is it's essentially bringing all of that to light, making it to where you don't have to be a finance expert to see all of the intense amount of value that a financial model has. And it's really just surfacing that, automating it, making all parties smarter and more efficient. And then our best feature is our team of experts that are going to help you all the way through the entire engagement, through any questions you have or anything like that. So if anybody's interested in Forecastr, Calvin, if you want to send a link to the beta out in the chat, then now would be a good time. Okay, so today we're going to be talking about, just to get a quick agenda up, the power of a great financial model. So like essentially, what it can do, the value that it can bring. We're going to talk going directly into the fundraising process. Once you've got your model built, how do you use it in a pitch deck? So what are some tricks to doing that? How do you present your model to investors? And then we're going to jump into a real world example, kind of like what we did last time. But in this case, we're actually going to do a live walkthrough of our financial model, the Forecastr financial model, like we're doing right now actively with investors for the Series A. So this is where some of that overlap comes in. I do want to kind of like start things with a question, which is, what is a financial model, right? So this is kind of some refreshing material from what we had last week, but there's a lot that can kind of go into financial modeling. So a lot of people have different definitions of what a financial model is, depending on, what's in their head. So if anybody wants to come off of mute, and I don't know how easy this is, so apologies, Calvin. Does anybody want to come off mute and give us their definition of a financial model, either from what you remember from last week, or if you're new, just kind of what you think a financial model is?
Can we bring people off mute, or should we just have them answer in the chat?
Oh yeah, either way, whichever one's easier. Answer in the chat if that's easier.
Try again.
You activated your phone. Nice.
It was my
Maybe
Apple.
your phone will tell you. Maybe we'll ask ChatGPT what a financial model is.
Maybe. Well, it'll put me out of a job probably if you just tell it. So anybody want to throw in the chat kind of what they think a financial model is? What is your definition of a financial model?
Let us know in the chat. What is a financial model? And again, if you were here last week, this question was also asked and answered.
It was asked and
answered. Go off of memory, or just go off, you don't remember, go off of what you think the answer would be.
Absolutely. So we'll go give it another like 10, 15 seconds, see if anybody's brave and wants to jump in. If it helps, you'll have my full respect if you put in an answer to this question into the chat. Otherwise, we'll have to keep trucking.
What's going on, y'all? You shy today? So what's up?
Shy today. There we go. All right, so we got Kathy. It helps you scale your business and forecast the future business success. Definitely. Yeah. So forecast is in our name. Yeah. So that's a good part of it. It's just forecasting, thinking what's going to be in the future. And then I like how it's like you kind of hit on both value propositions there too, Kathy. It's like it helps you scale your business. That's kind of the operational side of finance. And then forecast the future. That's kind of the investor side of finance, showing what's potentially possible. Yep. We got a way to understand how your business works, a management tool to help you take the right actions. Yep, I love that one. That's going more operational, right? Like, how do I use this as a tool to make better decisions and see what's going to happen in my business? And then understand the financial drivers and events of your business. Yeah, Chris, I like that one too. So great. No, that's awesome. And so I'd love to give you guys my definition of, oh, there we go. Brett, simulation of your business model with levers to test assumptions. So Brett, that must have been here last week, because that is getting into my definition of financial model. So this is a definition that was taken from Troy Hinikoff, former MD of Techstar Chicago, but it's essentially an analogy for trying to describe what a financial model is. And we went through this last week, but if you think through the early days of the car manufacturing process, the design phase looked a lot like it did in this slide, right? So you'd have these engineers that would sketch out on a piece of paper and a pencil, they'd sketch out what they think that the car is going to look like that they're ultimately trying to build. Then they would have to get this huge chunk of clay, and then they would sculpt it all the way down to the component level to scale with what that car is ultimately going to look like. And then once they get the weight distribution the way they want it, they've got all the components there, then they go out and build it with steel and rubber. Then they've got to find somebody to go out and test the car, put it on a track, and then see if it works, right? Sometimes the car would work fine. And then a lot of times, though, there would be issues, right? Because if you're trying to innovate at all, by definition, whatever you're testing has never been done before, right? That's just the innovation, right? So if you make any kind of changes that are new or novel, then you're putting a lot of risk into that person that's going in and testing. So if the car flipped over, that would be very dangerous. So the person that's doing that would not appreciate it. But then B, whenever there were issues, you didn't even know where the point of failure was, right? So if the car flipped over, now you got to guess what went wrong. And then you'd have to go back, you'd have to rebuild it, you'd have to try it again over and over and over and over again, right? So incredibly inefficient. You're wasting a ton of time. This is a very, very long process. It's a dangerous process, and it's just completely inefficient. So that's not how things are done now, right? Nowadays, cars can be built soup to nuts using software before you do any kind of physical testing, right? So you can design and test a car in minutes instead of months. So I can go into a CAD software. I can all the way down to the component level, to the screw level. I can see and build that car in my computer. Then I can take that car, I can put it on a virtual track. It can simulate all kinds of weather conditions, thousands of them, and kind of correlate them together to show where the risks are. If the car flips over, in this case, it can even identify the point of failure. So it can zoom in and say, the weight distribution was off, or this screw, or whatever it is. It'll literally tell you what went wrong so that you can go back and fix it. You do that until you get it right. And then once you've gotten it to where it's like been tested, that's whenever you can go out and you can build it with steel and rubber. And that's whenever you can go and physically test it on a track. And that drastically cuts down the issue rate, right? So, this is common practice now for good reason. It saves a ton of time, saves a ton of money, and it's safer, right? So we think that this is the perfect example whenever it comes to financial modeling, because using technology in the same way, you can simulate your business. You can run tests in minutes instead of years. So you can see what happens when you try a new product line, or you try out a new marketing channel or something like that, or you can go in and see if your business is going to be viable if it's very, very early, right? So this way, if you do it right and you simulate it before you build it, if there are issues, then nobody gets hurt. You don't get hurt. Your investors don't get hurt. Your co-founders don't get hurt. And it really gives you a chance to optimize everything before you jump in head first. So this is why financial modeling is so important, is it is a working distilled simulation of your business. Okay, so a financial model is going to hold the answers to a lot of really, really important questions. So now we're kind of going into why investors care about financial modeling, right? It's really the same reason that you should care about financial modeling. In general, it gives you information, right? It will give you a lot of interesting and useful information. So, I threw some of the just key bullet points that I'm sure people probably on this call have been asked by an investor at some point. So it'll answer things like, how much money should you raise, right? How are you going to spend that money once it's raised? So a lot of times people will go to market, they'll say, we need $2 million. Okay, well, why do you need $2 million? And that's where they falter. A good financial model will answer down to the cent, really, where you're going to be allocating those dollars and how things are going to work out. What's your hiring plan going to look like, right? Who can you afford? What are you going to be paying them? When are you going to be hiring them? All of that stuff. What are your levers, right? What acquisition channel should you focus on? Whenever people ask, how are you going to go from $1 million to $10 million? Having an articulate way of showing that mathematically, right, is so powerful, all the way down to the individual channels that you use. And then just answering milestone-based questions. When investors ask you, how many customers do you need to hit $1 million in annual recurring revenue? How many customers do you need to hit 5 million of annual recurring revenue? All of that stuff, if you don't have a financial model, it's going to be really tough to answer those questions. But a good financial model can be the source of truth for really these types of questions, right? So a lot of times, a very common question that we get asked by founders is, when should we invest in a financial model, right? Like a common response is, we're too early, we don't have enough data, we don't even have our revenue formula fully flushed out and all of that. So they just feel like it's wasted time, it's wasted effort, and it's kind of BS numbers, right? Like whatever we put in there is going to be wrong anyway. And that's kind of the sentiment that we get a lot of times when it comes to financial modeling. So in our experience, if you're looking at a seed stage and below, so kind of those seed, pre-seed, angel funded companies, that at that point, if you're that early, having a financial model is less of a necessity, like you have to have this to get a round done. Speaking about fundraising, it's less of a necessity, and it's more of a separator between you and all of the other startups that are out chasing out these investments, right? So an investor is not going to necessarily expect you at the pre-seed seed stage to have a really solid, buttoned up financial model, but it will certainly stand out to them if you can come to them with a really, really great financial model. In our opinion, this is what makes it almost more important to have a good financial model at the pre-seed and seed stage, because generally investors are in the business of saying no. Like if you look at kind of the distribution of, how many deals an investor sees and how many deals investors actually end up investing in, the ratio is pretty one-sided, right? They're largely in the business of 90 to 95% of the time turning deals down. So they're really poking holes in deals and trying to understand, why they should or shouldn't invest, but most of the time they won't invest. So if you're in this line of people that are lined up to pitch this investor, you don't want to do any unforced errors, and you want to do whatever you can to stand out from the pack, not just the bare minimum for blending in with the pack and checking the boxes, right? So because a financial model is going to help you stand out, we think that it's really important, even at the pre-seed and the seed stage. It's going to help separate you from the thousands of others of people that are trying to pitch this investor, right? At the Series A stage and beyond, so kind of like where we are as a company and beyond, you can't get away from it. It's table stakes, right? It's a part of due diligence. An investor's going to want to walk through your financial plan. They're going to want to dig into your historical financials. They're going to want to understand what the future economics of the business look like. So at the Series A, you're going to need to have it. It's our recommendation that you invest early on in a financial model so that by the time you get to a Series A and beyond, you're going to have a deep understanding of what your projections, like the mechanics of your projections, and better yet, you'll have an audit trail of historical variances to your forecast leading all the way back to the pre-seed and seed rounds, right? We're seeing this real time, blows investors away whenever you can not only show them your forecast, but then show them several months, if not years, of detailed analysis as to what you said you were going to do and then what you actually hit. And if you can run a tight variance, that gives them a lot of confidence in your future numbers. So the TLDR here is invest in it early on. That's our recommendation, because at the Series A, you're going to need it. So moving on into kind of like getting into the fundraising process, right? We want to talk about how we want to showcase your model or your projections in a pitch deck. Now, when I say pitch deck, what I'm really referring to is kind of what probably everybody thinks of when they think of a pitch deck, that concise 10, 12, 15 slide deck that's trying to explain the mission, vision of your company. So that's really what we're talking about. For the purposes of the rest of this presentation, we're going to assume that you have a financial model built. So we're assuming that you've done the work, either in Excel or Forecastr, what have you. You've got a financial model built. So what we're going to be talking about now is once that's built, how do we loop that in to that investor conversation? So if our recommendation is in that concise pitch deck, just having one slide for the main section of it, just have one slide that digs into the financial projections, right? Don't overburden it. Don't make it a big thing. Just have kind of one slide that goes into it. Now, in that slide, you want to keep it relatively high level. So this is a real snapshot of the slide that we used in our seed round whenever we were pitching investors. And we went deeper than I would recommend most companies go because we're a financial modeling company. So one really popular thing that we've seen in pitch decks is just a graph of revenue with some big numbers to show what stabilized margins would look like and things like that, just to give them a preview of the future of the company, just to kind of get their interest going. Now, we recommend keeping it high level in the concise pitch deck for a couple of reasons. So one is that the initial pitch, we're talking about intro meetings, maybe first, second time that you met with this investor, the initial pitch should be focused on really one thing, which is getting that emotional buy-in, that excitement for your company. So you want that investor to be excited about the opportunity, and you want to use this model, or you want to use this time, this early time with them to sell them on your vision, to sell them on your team. If an investor is not excited about the opportunity, then there's no point in digging into the financials, right? You'd be putting the cart before the horse. Let's dig into our P&L before you even are excited or know fully about what we're doing. Don't burn time doing that, right? Spend the time getting that emotional buy-in for the company. Second, which is kind of another related reason, is that if you go too deep into the numbers too quickly, it veers the conversation into a weird spot, right? And so what you'll see is number fatigue and analysis paralysis, where if you've got, let's say, a 30-minute meeting, an investor may zoom in on a 25% margin and take the conversation way deep into the trenches, when instead, to my first point, the time should be spent giving, context in the business, that getting that emotional buy-in and all of that. So if you spend too much time going into the finances too early, then you're gonna veer the conversation towards the direction that you really don't want it to go in. But the third reason is that you want to use this as the hook to get that next meeting. So this is kind of the secret whenever it comes to using a forecast in your pitch deck, is you want that graph, if you're using a graph, to be just interesting enough to where they're like, where did you get those numbers? Like, why do you think it can be this opportunity? Like, tell me a little bit more about your economics. You want it to be just interesting enough for them to have that question, but you don't want it to be so deep that they can spend the time on that slide and get the answers that they're looking for, right? When you put a slide like that, or you put a graph like that on a slide that shows the trajectory of the business, a good savvy investor is going to want to dig in more, right? They're going to want to understand how you got them. And this is your chance to set up a follow-up time for an entire meeting that is specifically for this reason, right? A specific deep dive into the forecast. Let's go through all of the numbers, type of meeting, right?
Can I add a note on this, Logan?
Oh yeah, go ahead, Raj.
Yeah, so I think everyone needs to really take this point to heart, because I think the worst thing you can do is screenshot your spreadsheet,
yes,
and then paste that into your slide for a few reasons. As Logan said, numbers fatigue, right? You've got so many things on the page. Whatever you are saying in that pitch, they're not listening to anymore. They're choosing which column they want to analyze or which cell they want to analyze. And then their eyes going to follow in a direction that they want. This applies to whatever you're going to show for your numbers, but also really any slide in your deck. Like, really think about where you want people looking.
Yep.
And if you've got too much information on there, they decide where they want to start. It's your job to create the starting point and the ending point of that slide for them in terms of the information you choose to provide and how you display it as well.
Yeah, that's a great point, Raj. And I go into this a little bit more in the following slide, but the general, this is true throughout life, not just fundraising, but the general rule is get the emotions first, right? Get the emotions first. Like before we go in and like I show you my LTV to CAC ratio and we look at my month over month growth rate and I do all that, I want you to be like, this is a great opportunity. This is a great team. This is a great idea. There's tons of time for that. Trust me. Like if they're going to make an investment, they're going to dig into that. That's what they do. They're professionals, right? They're going to dig in to the economics and there's a time and a place for it. But the time and a place for the first meeting is get them excited, get that emotional buy-in, get that real human connection, right? And show well in front of them. So, but to Raj's point, you want to be able to lead up to that second meeting because you want that meeting to happen. You just don't want it to happen right now. So this is a good opportunity to do that. They're going to look at it. They're going to say, hey, how did you get those numbers? I'd like to understand kind of like your thoughts for the future of the business. And so this is an opportunity to set up that second meeting. So this is a really good way to build trust with an investor. We like to break down that trust is really built in two ways. It's built through familiarity and confidence, really is kind of the way that we think about it. Like trust is built through familiarity and it's built through confidence. And so getting a meeting set to dig into the financials of your business builds both of these things. Because just one more meeting is more face time. That's more familiarity. I'm now more familiar with you. I'm getting more comfortable with you. And not only are you getting more familiar, you're doing it in a meeting where I'm going to walk you through the future of our company from a financial perspective. That's a very confidence building exercise. If you can execute that meeting well, the investor's going to walk out of there with confidence and say, that person really knows what they're doing. Like they just walked me through the future of their P&L. They're on it. Like they get it, So it's both of those things, and both of those are very, very important. So we've talked about kind of the first meeting, the pitch meeting, you're building confidence, you're showing your vision, all of that stuff. So we've gotten to the point where we've shown that slide. The investor's like, I want to dig in more and understand the future. Now I want to talk about that second meeting, right? Now I want to talk about that more deep in the weeds finance meeting where we're going through the numbers, going through the metrics, all of that stuff. So I like to break this down and look at each part of the meeting specifically. So we look at the before the meeting, the during the meeting, and then after the meeting. So starting from the top, before the meeting happens, it's our recommendation that you don't send the financial model to the investor before the meeting, right? This is a somewhat controversial topic, but we've done financial modeling for a long time. We've seen what happens, but we feel really strongly, and we recommend all of our clients hold fast and don't send the financial model before the meeting because you don't want a financial model to live on its own. You want to be there in the meeting. You want to control the narrative, and you want to present the financial model to them in person or on a call. So this will do a couple of different things. So one, it's going to give you a little bit of leverage to get that next meeting, right? If an investor just wants to dig in the numbers, they're like, just send me your spreadsheet. If you do that, then there you go. You've scratched their itch and there's no meeting, right? But if you're like, look, we run a tight process when it comes to diligence in the financials. I would love to present my financial model to you, and then I can leave a financial model with you at the end, right? So that's what you can do. So to give you that leverage to get in the room with them again, and we've already talked about how that's important through familiarity and confidence, right? So it'll give you that leverage to get that next meeting. The second thing it'll do is it'll help demonstrate that you understand the business without with you presenting it. So, if I just send you a spreadsheet or something, or a Forecastr account, and I'm an investor, I don't know if you paid $20,000 for a consultant to build this for you and you actually don't know what's going on, or if you yourself built it or work in it every day and have working understanding of it. So if you do have that understanding, this is your opportunity to flex on the investor and show them in this document, I understand all of it and all that. So that's going to help build confidence. And we already talked about how a financial model is a simulation of your business. So if you show that you understand your model, you're showing that you understand your business. Those two really directly translate to one another. But most importantly, it allows you to control the narrative. So so we've already talked about how investors are kind of in the business of saying no, as a matter of speaking. So when an investor or really anybody sees a financial model, you initially have some sort of reaction to it. If you plop anything in front of you, you're going to have a reaction to it, positive, negative, or neutral, right? If I'm there with you and I'm presenting the financial model, I can shape how your reaction is going to be through context, right? So I can shape whether or not you have a positive reaction to it or a negative reaction to it or a neutral reaction to it. If I'm not in the room, I have no control over how you're going to react to that financial model. I don't know how you're going to react to those projections, right? If I have a question on, like perhaps, for example, an investor has a question on churn rate. They look at the churn rate and they say, there's no way they're going to get churn that low. And then that's it. Like I've made my decision, I'm done, right? Versus if I'm in the room with you and you have a question about churn and how it's going so low, I can show you our product roadmap. I can talk to you about the processes that we're outlining. I can give you comps of companies that we've talked to that have gotten churned down that low. I might be able to talk you out of that negative reaction to it. And human nature is, once you've made up your mind about something, it's a lot harder to change your mind than it is to just shape how that initial impression is made in the first place, right? So this gives you the opportunity to do that. It gives you the opportunity to kind of shape their reaction to the financial model, right? For the record, I've heard a lot of people that have the same idea when it comes to pitch decks too. That one's, I think, a little bit more controversial, but that's something that we've heard of a lot too.
Hey, Logan.
Yep.
Don't mean to interrupt, but it seems pretty relevant. We have a couple people in the chat. Looks like Ron and James. They're asking if the financial model should be included in a data room, or where that fits in this whole, what an investor should get access to.
Yeah, it's a great question. So yes, it is. It should be, and it's in our data room. The way that we do it is that we have for our Series A, we have an output of our Series A financial model sitting in our data room, that you can go in and you can look at kind of like more granularly what's driving your financial model, but still the individual logic behind it is not in there unless we send them an Excel version of it. So typically though, we like to try to fight for a meeting to go through the financial model before we give access to the data room for investors. That's not a hard and fast rule. That's just something that we personally like to do. And I would say generally, this is kind of a squishier rule. This is not like a hard and fast 100% of the time. Do not give a financial model to an investor before they, unless you meet with them on it. It's more so if they have any question about the financial model or anything like that, get on the phone with them and walk them through it, because it's going to help them. It's going to help them get the right context, right? It's going to help them understand it better. So to directly answer your question, it is going to be a part of due diligence. So therefore it does need to be in the data room. Usually though, we try not to go first meeting straight into here's my data room, go nuts to diligence. Usually we say, here's first meeting. We'd love to set up a second meeting to talk to you more about the future of the company going into our financial model. Set up the second meeting, go through the financial model in depth. I promise you, if you execute that meeting well, that is the most impressive meeting you can run. And that'll really whet their appetite for digging in further into diligence. And that's whenever we give them the link to the data room and let them go deeper into due diligence. So
I think, so a couple of points to add to that. First off, this idea of don't let a model stand alone. For any of you who are doing B2B startups, this is the exact same approach you should be taking to your proposals you're sending out to customers. Do not send them a proposal or a contract just and expect them to come back and be like, yeah, we're doing this, right? You want to be able to have that sit down with them and walk them through the pricing and why the pricing is the way it is. So it's the same exact concept you'd apply in sales that you'd apply to your investor meetings, which is another form of sales.
Yep.
And then on the point of showing it in the data room or not, I think the last thing Logan said there is really important to understand is like, you shouldn't be going in giving out your data room at first touch anyways, right? They're only getting access to your data room if you're in active, deeper conversations with them. And so by that point, they should have already gone through it with you in person or over a call. And so now they're looking at it because it's part of the follow-up of having seen it live. But the first time they saw it was not passively on their own.
100%. I think it's sometimes easy to forget that you as a founder have leverage as well. It's not just the investors, right? So if an investor asks you for something, you don't have to jump immediately and send them immediately what they're looking for, right? You can say, look, I'd love to give you the information that you're looking for, but this isn't how we do things. We're a person-driven company. We like to build through relationships. Let's set up an hour and I'll give you everything that you need, and then I'll leave it with you then, right? So, and psychologically, that actually works really well whenever it comes to fundraising, because it shows the investor that like you're not a pushover. You know what I mean? Like, look, no, you want this, I'm gonna give it to you, but like do it on my terms. You know what I mean? It's kind of like an interesting psychological effect you see there.
And to that point, like, understand like where like your stance in a meeting, right? And in this entire like interaction overall, yes, you're asking them for money, but you're not asking them like for free money. Like the money is in return for a stake in your company that you're going to do all the work for to give them their return on. So it's not like please, 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 right? It's more like no, like you gotta like own your presence in that interaction, and I don't want to say like stand up to them, because that's not supposed to be this like combative conflict kind of thing. But you are their equal, not their inferior or their subordinate.
Yep. It's worth noting that a lot of investors wish they were you too. You know what I mean? Like without you, they wouldn't have a job, right? Like that's you are their job, is to like, you know what I mean? So yeah, it's a great point, Raj. And that actually leads into the second portion, which is like when you're in the meeting, like be in control, right? Like you are their equal. People, this is for a lot of our customers, and we kind of talk them into position with this at Forecastr. It's like, people get afraid of these types of meetings, these deep in the weeds due diligence meetings when it comes to finance. I love these meetings. This is my opportunity, and like a lot of our clients now, opportunities to just impress the hell out of those investors. And you treat it like a working session, right? These meetings are a working session where you and the investor are working together and using the model as a tool to analyze what's realistic about your business. So conceptually, think about it as me and the investor versus the model, not me and the model versus the investor, right? We're looking at what the future of the company is. I'm going to present to you what me and my team put together and what we think is realistic, and we'll talk about that. But if you have different opinions and challenges and things like that, you know, you're entitled to them, and perhaps we can have an intelligent discussion about it. We could even, in some instances, run some scenarios, see what happens whenever you change certain things in the business, and like what levers can impact, you know, the future of the company. I'll give you a tangible example of this. So whenever we pitch investors, one of the biggest metrics that they have questions about is our churn rate, which is true for pretty much any SaaS startup. I'm sure people having to defend their churn rates if they're relatively high. When we first launched Forecastr, when we first started getting customers in and they came up for their renewal, we had an atrocious 80% annual churn rate. So I mean, 80% of the customers left because it was so early, the product. Over the year, we've beaten that down to about 25% annually. So it's gone down significantly, but people still have questions about it. But one of the most powerful things we can do in that demo is show you, look, we've proven that we can cut this, we've already cut it into a third of what it used to be, and it's still going down. It's still going in the right direction. But let me put you at ease a little bit. If you assume no improvement in churn rate forever, right? If you just keep going at the same churn rate, what will the business look like? And it's still this massive opportunity, right? So stuff like that is just really, really helpful.
Can I ask you a question, Logan?
Absolutely.
I'm curious to get your take on this. So my belief is that when you are having that meeting with them, and you're walking them through the model, is you don't have to like start with like top line revenue or start with EBITDA. Like, especially if it's a screen share and you're controlling the screen, like control the scroll and start with the number or the metric that you believe is the most important one that they should be focusing on.
Yep.
Is that okay? Do you believe that as well?
Yeah, no, I think that that's 100% true. I mean, we have a lot of companies that revenue is not the most important metric for their business in some cases. Like it's like if you're a like Facebook, for example, right? I mean, like revenue wasn't their number one focus whenever they were fundraising. They just wanted their user count to go up. But if there's one metric that the conversation is going to gradually gravitate towards. I think it is important to like show strength and understanding of your business and call it right there. You know what I mean? So I think that is good advice, Raj.
And I think it's like, it's not just like saying, hey, let's look here, let's not look there. Let's start here because this number is important for this reason, right? We know, that this is the key to unlocking these other things, right? It's having a reason for why you draw their attention that way.
100%. Yep. I totally agree with that. And then, so after the meeting, just to move along here, follow up, right? Summarize. So this is actually one point that it surprised me that a lot of people don't do a good job of. It's just making sure that you follow up, summarize what you talked about, then send a copy of your financial model once you had the opportunity, because now you've given them context, they understand it. Now they can dig into their heart's desires. So this is also a really good opportunity if you got asked a certain question or something like that, you can create even a scenario unique to them and send them that scenario and walk them through it, right? In our case, if we were getting beat up on churn, I'd probably send them a copy of our financial model and then maybe even send them a new one and be like, by the way, I created this other version you can check out if our churn doesn't improve, and you can see that revenue's not that different. You know what I mean? Like maybe a little bit less, that type of stuff. So fortune's in the follow-up. Make sure you follow up, give them all the information they need then. And I know that we're running a little bit lighter on time than I would have liked. So I'm going to jump in really quick and walk through our financial model and just talk a little bit about the flow, but then we'll open it up for questions because I'm sure there's going to be a lot. So generally the flow that I like to take whenever it comes to executing on this meeting, like first of all, you'd like to, thank the investor, all of that good stuff. I usually like to start with the mission, vision, and values, or like really, I start the meeting mainly with a vision. And I'll say for us, it is our vision to become the default operating system for financial planning and analysis for the venture-backed ecosystem. So all startups, that's really what we want to do. What I'm going to be walking through today is our plan for how we're going to execute on that in our financial model to show kind of what the opportunity is and all of that. So I do what I call a zoom out, zoom in approach, where the first thing that I'll do is I'll show the opportunity, right? I'll give them a sense of why we're excited about this opportunity and how big it can be. So in our case, we can show kind of like what, if we're looking at, going out to, let's do 2028 to show that 5-year projections. So out in 2028, $140 million of revenue in the model right now, that's $1 billion company, if you're assuming standard SaaS multiples. So that's showing that opportunity of being able to execute on that $1 billion opportunity, right? So I start zoomed out just to kind of like show you what the opportunity is. Then I zoom in and I go monthly and I say, now I want to talk about specifically how we're going to get there, right? So I can show that we forecast monthly. We have our targets that we want to hit every month. I can even show you with actuals what's actually been happened. So this integrates directly into our accounting software. So we can go in and pull in all of the actual data. And I can show you how tight our variances have been to date. So you can see kind of like, 1% variance here, 2% variance there on revenue. This is a 0 right now, so it shows 100% variance, but it will show you like how tight you've been and things like that. So go through, talk about monthly. Now I go through how specifically we're going to be getting there, right? So like talk to you about the opportunity and how big and attractive it is. Now I want to walk you through step by step our plan to actually execute on this. And that's where we go into the assumptions. So the flow that I like to use is starting at customer acquisition. So I go, how are we getting customers? How are we turning those customers into dollars with revenue? What does the team look like that's going to execute on this? what other expenses is it going to take for me to get here? And then I usually end on equity to talk about why we're having the conversation with the investor. So in our case, we'll say diversified acquisition funnel. You can see how we're getting new customers. You can see that our biggest one is strategic networks. I could expand this and explain all of the different metrics here to show, we have 165 partnerships active, up and running. They give us 0.275 on average leads per partner. We're going to scale that out over the next year to get to 250 partnerships at 0.4 leads per. And assuming standard conversion rates, that's how we plan on growing. Then we can go in kind of like line by line and talk about and really zoom in where they want to go if they have any questions, and walk through how we're going to be executing on the plan. And then we loop that into revenue streams to show how we're going to be turning those into revenue. And, for us, we have a multitude of different subscription plans, and then we have services that we offer and things like that. So we can walk through all of that. And for the sake of time, I'll kind of like skip through here pretty quick and show, we've got all of the people that we hire. We can go all the way down to the position level and show how much money they're going to be making and things like that. But then I usually end on this equity section to say, this is kind of where the ask is. None of this is possible without the investment that we're looking for, right? So like in our case, we're raising $8 million. If I go to my statement of cash flows, I can see that, without this, 7.45, like, which is the remainder of the 8 million that we're looking for, without that money, we would run out of money in about 6 to 7 months, right? So for us to execute on this, essentially this big vision, like for us to post these returns, we need this investment, or else we're going to die before we get there, right? So that's kind of the frame that I like to use whenever we think through this, and it's a kind of a good way to manage it. And I want to open it up to questions. Now we got about like 9 minutes, it looks like. So offer I'll make, same offer that I made last time, 25% off of Forecastr's annual subscription. The base package, if you have less than $100,000 in monthly expenses, is $2,000 a year. That covers all of your white glove onboarding, working with an analyst, investor sniff tests, all of that good stuff. So we'd love to work with everybody. If you want to work with us, just use the link that Calvin just put in the chat. So with that, I will take any questions that y'all have.
So we got a couple questions in here. Shubha asked, can you walk through the biggest mistakes you see non-financially trained founders make when talking about their financial model, especially if they are pre-seed or seed round?
That is, so there's two that I want to call out. One is overly defending the output of their model, right? So whenever I go through a financial model, the first thing I say is, like, I always say, Mr. or Mrs. Investor, the first thing I want to tell you about this model is that there's 100% chance that it's wrong, right? This is a best guess. This is a planning tool, right? This is our best estimate and goal setting tool that we have from a financial standpoint. I'm going to be walking you through that. But what's not helpful is pointing at year 5 revenue and like debating on whether or not that's the exact number, right? So, and that's why a lot of times financial modeling gets a bad rap, is people are like, all these numbers are wrong anyway. So like, what's the point? Of course they're wrong, right? Just like, you're always off on a goal that you set to an extent, but the point is, it's a planning tool, and it's helpful to have these kind of metric sets that what you're marking towards. So that's the first mistake, is just like overly defending out year projections. But then the biggest mistake, honestly, is in the creation of the model, right? The worst thing that you can do to an investor, like whenever you're coming towards like presenting your projections, is presenting a model that shows this is a $60 billion market opportunity. If we can just get 1% of that, then this is our revenue, right? That is not a very interesting conversation. It doesn't really tell you anything, right? All that tells you is that 1% of a big number is another big number, which we of course all knew that, right? The details are what's important, right? How are you getting that 1%, right? What is your sales channels like? What are your customer acquisition strategies like? What does your sales cycle look like? What are your conversion rates? Like, how many people do you need? Like, that's the type of stuff that you want to get into, not, this is a big opportunity. I'm going to get 1% of that, and now ask for a check, right? That's a big mistake that we see all the time.
The on the point of can you say how you phrase it again? Because I want everyone to like literally write that down. The first thing you say is there's a good chance that this model. What was it again?
Yeah. So I say the first thing I want to tell you about this model is that it's wrong. Is usually what I say. Or there's 100% chance that this model's wrong, right? We're focused on the logic, right? And I'm going to tell you kind of what our goals are. But if you're gonna, but you don't want to be held to, in year 5, I will hit $140 million of revenue, right?
So everyone, please write that down, right? Open with the first thing I want to tell you about this model is that there's 100% chance that it's wrong or it's off or something like that. What the psychology behind that is you are disarming them.
Yep.
Right. You are making it a much easier conversation to have because you're letting their guard down by being like, look, I'm aware I don't have all the answers. So let's just agree that we're all doing the best we can with the information we have at this point.
Yeah, that's exactly right. And that is exactly how I like to describe it. It's disarming. It's showing you that, because a lot of times people, they present it and they're like, they have to present that this is what's going to happen. This is 100% truth. And it's like, no, I mean, this is us doing our best and all of that. So
let's see if we can get a couple more in here. So another one from Shiba that came in about halfway in was, how do you strike the balance? Probably a nice dovetail to that last question. How do you strike a balance between getting the investor excited versus not over projecting growth and having, the dreaded hockey stick or like year 1 idea, year 2 profit?
Yeah. So there's nothing to dread about the hockey stick, so long as it is founded in logic. Essentially, like, I mean, for us, for example, like most investors, when they're looking to make an investment, depends on the fund, but generally they're trying to return the fund, which means that they're looking for a company that is a multi-billion-dollar opportunity, right? They're going to deploy tens or hundreds of investments, and they really just need one or a very small percentage of them to hit in order for their portfolio to be successful. So a lot of times that's what they're looking for. So you want to be able to show that you have the potential to be that company, right? We can be that company, that outsized return to your portfolio. But I want to show that we can get there using the economics that we've proven work, right? Or economics that are reasonable, and it will accurately, to an extent, right? It'll directionally accurately show you kind of the capital that we're going to need in order to get there. So in our case, like if we're going to get there, if we're going to be that billion-dollar, multi-billion-dollar company, what does the ACV need to look like? How many customers do we need? How many people do we need selling those customers? How many analysts do we need to support those? And if we can show that and show that, look, we can scale, this is possible, right? That's what you're showing. This is possible. We can do this, like with this type of data. I'm not saying like stomping it in the ground saying this will happen 100% to this dollar, right? But I'm showing that like we're the team to do it. There's a massive opportunity and this is possible, right? That's really what you're showing. So what I will say is like, if you're gonna say I'm gonna be a $1 billion company, show the projections of a $1 billion company and stand by it and be like, look, like, yeah, like that's what we're shooting towards, right? So that's my general opinion on it.
It's the Kevin Garnett approach, right? Anything is possible.
Yes, exactly.
Ron asks, how do you avoid the 1% of China mistake when presenting SOM in context of TAM, SAM, SOM?
Yeah. So I think that the whole like TAM, SAM, SOM, like all of that stuff, it's good to just have those in a deck and let them infer that the market, because all they want to know is the market big enough, right? They don't have to see what 1% of a big market is, because if the market's big enough, then like that's really all they're looking for. So like, but what you don't want to do is show the entire operating plan of your company being based off of the TAM or something like that. Really, whenever I see a financial model that's just like our year 5 revenue is 1% of a big TAM, it's just like, to me, it's like, you don't know how you're going to get there. You're just throwing two numbers together and you're just claiming that it's going to happen. What I want to see is how many people does a sales team need to reach out to, at what contract value, at what sales cycle, and how does that scale and what does that look like? That's the way that you want to go about it.
Okay, let's see if we can get one more question in. We also had Chris asking where one can find the latest goth rap artists.
Spotify, type in NF, you'll see him.
Ken asked, as I understand the software from your overview, so Forecastr, this Forecastr allows you to model and upload a variety of revenue sources. For instance, our company sells event tickets, subscriptions, individual SKUs, all with different churn associated with them. Would that work with Forecastr?
Correct. Yep. 100%. That's exactly right. Yep. You can have different assumptions for each of them, have them all tie together, and have multiple scenarios with different assumptions within them. So we'd be happy to loop you up with a demo and you can see kind of what we're talking about. And
the final question on the product with Forecastr, I know you said the mission or the vision is to be the default operating system for venture-backed companies. What about for companies that do not plan to raise capital, but still would benefit from a financial model? Still good?
We've got tons of those that use Forecastr, and we don't forget about them. The reason that that's not a part of our vision is that we're mentally orienting around the venture-backed ecosystem. But finance is kind of ubiquitous, whenever it comes to venture-backed or non-venture-backed. They have the same pains. But that's just, if we can deepen that level of with venture-backed, then it introduces the concept of investors and communicating with investors and all of that. Sure. So it's a great question, though.
All right, y'all, we have hit our time. That concludes the second of 3 Forecastr Fridays. Thank you again, Logan and Calvin, for a wonderful session. Next week, we come back for the third and final Forecastr Friday, which you've got the financial model. You've closed some checks, some investor deals because of that financial model. Now it's going to be, how do you use these two things to supercharge your business? As I like to think of it, how do you use the cash on hand now and the model to spend like you've been there before and not blow it all away and not pull an FTX potentially? We'll come back next Friday with that. One other note I want to share with everyone, coming up in February, Startup Hype Man is launching an online community dedicated to teaching go-to-market strategies. One of the things Logan talked about earlier was it's not just about saying the number, it's how you're going to get to that number. And that's something that in all the pitches that we have worked on at Startup Hype Man, we consistently find is an area where startups need a lot of help, is in helping refine or figure out what their true go-to-market strategy should be. So we are launching the GOAT to Market Club to help you become the GOAT of your industry. The official launch date is February 3rd. If you would like pre-launch information, though, just shoot me a note. It's going to be an awesome thing. Every month, we're going to have a monthly strategy drop where we deliver a micro workshop that you can't get anywhere else, teaching you a specific marketing, sales, customer acquisition strategy, something that's going to help you become the GOAT to market. So with that, we will see y'all next Friday, everyone. Have a great weekend, and you'll get the recording from today sent by Forecastr next week. Take care.
Thanks, y'all. See you guys.